Okay, class, today we're going to go over lump sum purchases. Sometimes when we're purchasing assets, we do it in one transaction, just a single transaction. I have an example here where we're purchasing a building and then there's some land improvements and land. So we're purchasing these items for a purchase price of $160,000. Okay? We have to allocate this $160,000 to these different assets because for depreciation purposes, they depreciate under different terms, under different lives. Okay? So we have to figure out how much of this is going to be allocated to building, how much will be allocated to land improvement, and how much is going to be allocated to land. Land doesn't depreciate at all. Okay? All right, so the process, first of all, is to figure out what their current value is. So I put down the appraised value. That's one way to do it. We can get an appraisal done or find out what the value is for these three items, the true value right now. And our appraised value is $140,000 for the building, $20,000 for the land improvements, and $40,000 for the land. So our total appraised value is $200,000. But once again, we're only paying $160,000. So we're getting a little bit of a deal here. So how do we allocate this $160,000 between these? Well, we're going to take a percentage. So we'll see what each one of these is a percentage of the total. So for example, we've got the building. It's $140,000 of the $200,000 appraised value, which is 70%. Okay, so $140,000, I'm knocking off the zeros, and $200,000 is 70%. Then we've got the land improvement at $20,000. So $20,000 divided by $200,000 is 10%. Okay, so that's 10% of the appraised value. And the land improvements, I think you can figure this out, it's 40 divided by 200, or 20%. So just to verify that we did this right, it better add up to 100%, and it does. So we have the true percentages for these three assets. Now what we need to do is we need to figure out how much of the 160 goes to each one. So we're going to take 160,000 times the 70%, which is 0.7, okay? And that will get us 112,000. So of the 160, 112,000 will go to the building. Then we take the 160,000 times the 10%, which is 16,000. And finally, we take the 160,000 times 20%, 0.2, which is 20%, which gets us obviously 32,000. Let's just verify, let's add these up. They do add up to 160,000, okay? So we've done this correctly. We've allocated our purchase price to these three assets. 112,000 will go to the building, 16,000 will go to land improvements, and 32,000 will go to land. So if we wanted to see the journal entry, we'll just do this really quick. I'm going to abbreviate building, land improvement, and land. These will all be debited, they're assets. So we'll get building of 112,000, land improvement 16,000, that's the debit, and land of 32,000, sorry, a little bit messy. And then our credit is going to be to, if we pay cash, we will credit cash, which will decrease cash. Or if we have a liability, maybe a note payable, if it's a liability, then we would credit note payable for that amount. All right, so this is how we do lump sum purchases. They're fairly common in business, and it's just a way for us to allocate the true purchase price to the various assets that we're getting in this one transaction. All right, thank you, class.